you're buying stocks but not the right ones. In this video, I want to talk about stock selection process and how you can pick good stocks. This is why you clicked on this video. This is what you will get. I will give you some tips so you can only select the best stocks that will compound your wealth in the long term. Specific tips that you can use right away so you can improve your portfolio right now. Because now we live in the golden age of information. You have too much information and people cannot differentiate whether something is important or not important. They go on YouTube, they go on Twitter, too many things happening at the same time. How do you know? What are the good filters to use to only pick good stocks? In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year because I have focused all my attention on specific filters. So, first point, most investors look at too many metrics and miss the only one that matter. I can tell you this firsthand because I've been following the investing industry for more than 10 years now. I've had some professional experience in asset management funds, and I can tell you that people like to act smart. They want to think they are very smart. It's a world where you have buzzwords, complex words. If you watch the movie The Big Short, they will tell you exactly the kind of words you want to hear because you can sound very complex. But actually, investing in businesses must not be that complex. You can use simple words, explain the investment thesis very clearly. You don't need to focus on everything for a public business. You can only focus on 3 metrics that are important. And people, I don't know why, but they don't like this. They don't like simplicity for the sake of simplicity, okay? They like to use complex models, complex discounted cash flow models, complex analysis, forecasting too many things at the same time, playing smart. I'm telling you, it doesn't work. When you analyze a company, you want to spot 1, 2, 3 KPIs that are very important for the businesses. And you can do this exercise right now with your own portfolio, like today, right now. You can say, what are the 3 metrics that make my stock go up? If you can't answer this for all your stocks, you have not done enough work, okay? If you can't name 1, 2, 3 things that make your stocks go up, it means you have not understood the real process behind investing. Sometimes investing is that simple. You don't need many things at the same time. You only need to focus on one single metric and monitor one single metric. And if this metric goes up 20% per year, your stock will go up by 20% per year. Fairly simple, right? But very few people do it. And this is why you click on this video. So thank you for that. So sometimes you work too much, and instead you should have focused on one single thing that mattered. I can give you an example. I was a shareholder of Evolution AB, and the most important metric that impacted the stock price was the organic dollar-adjusted revenue growth rate. Not the revenue from acquisitions, not the revenue for M&A, not the margins, not the free cash flow, but the thing that impacted the stock price the most for Evolution AB was and still is the organic revenue growth rate. Organic means in-house, right? No acquisitions whatsoever, just pure reinvestment opportunities. And if the organic revenue growth rate is going up, is improving, the stock was going up, and for the past few years it has gone down despite high margins, etc., etc., etc. So if this metric is going down, the stock is going down, and the stock has been going down. And maybe 1 or 2 people on the internet spotted this. All the other people focus on other things because they want to sound smart. But again, I'm saying the same thing. You don't need to sound smart in investing. You can use simple words and it will work, okay? By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. Second point, I just focus on a few key filters: strong growth, high margins, and consistent free cash flow per share. These are 3 key filters that you can use right away today to your stock selection process in the future. Meaning, if you want to buy stocks, you can use a filter, you can use a screener, you can use Fiscal AI. You have discount codes in my description if you want to use my affiliate links, like 15% cheaper. These are the best tools I'm using on a daily basis. You can go to these websites, the link in my description, click on them, create an account, and use the screening tool. What are the filters you want to find the best stocks? You can put strong growth, revenue growth is fine, earnings per share growth is fine, EBIT growth is fine, above 10%. You want high margins, depending on your business style, investing style, you want operating margins above 15-20%, I would say. And consistent free cash flow per share. In the very long term, for most companies, the free cash flow per share is a good indication of intrinsic value. If the free cash flow per share of a company is growing 10% per year, it's very likely that the stock price in the very long term will go up by 10% per year. Like 10% per year, 10% per year, 20% per year, 20% per year. Stock prices will follow free cash flow per share in the very long term. So you want to only be invested in companies that are growing their free cash flow per share. Pretty simple. You don't need to be a genius to know this, okay? Next point. I don't care if a stock is hyped. I care if it fits my criteria. Yeah, right now I started this video saying this. We live in a golden age of information. You have too many YouTube videos, too many Twitter posts, too many articles on Substacks, Seeking Alpha. You may be seduced by appealing opportunities. I would say 90% of the time it is a mistake. It's better to focus on boring companies that fit your criteria, and you will do fine. I've been investing for almost a decade and I've done this strategy, so I can tell you it works, right? Next point. I only keep stocks with real pricing power and durable competitive advantages. Oh, that's important. Now, we live in a market that is rather expensive, right? The PE ratio for the S&P 500 is quite expensive. And we also live in a world with inflation and uncertainties as always. Which means if we live in a world with inflation, you want to be invested in companies that will not suffer from inflation. Actually, in the golden scenario, you want to be invested in companies that will benefit from inflation. If inflation is 3%, this company can increase their prices by more than 3%. They can increase their prices by 4 or 5 or 6%. A good example is Moody's and their ratings segment. So for the past 15-20 years, Moody's has been increasing their prices for ratings 1 or 2% more than inflation. It's stupidly simple, but it works, okay? So for me, for my investing style, I only want to be invested in companies with pricing power, okay? And durable competitive advantages. You want something with the moat that can't be disrupted with AI, that can't be disrupted by competitors that are coming, can't be disrupted by hungry sharks from China. Yeah, it will happen eventually. If you are in the retail business, Chinese companies will eat you. The competitive hunger from China is absolutely crazy, and people underestimate how fierce Chinese people are. Meaning, if you are a retail store in the US, or I don't know, online store, you sell cheap stuff, and then you have low margins, and then a Chinese competitor comes into the industry to disrupt you. They will lower their cost basis. They will lower their price, most importantly, to have a very razor thin margins. So the Chinese guy will not be profitable. They will be at break-even or maybe burning cash a little bit, but you will have small margins, so they will survive for a couple of years. And they will completely steal all your customers because the competition from China is fierce. It's in their DNA to do this. They will come into your market, have the lowest price ever, even if the margins are ridiculously small, but they will still survive, and they will kill you. slowly but surely. And they don't care about making money. It's a different culture, right? They don't care about being massively profitable and scaling operations. No. They will do volume, 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 volume. Raise thin margins, but volume, and they will kill you. And when you are dead, they will steal all your customers. You don't want to be competing with Chinese companies. You don't want. If you look at my portfolio, very few companies I own are competing with China. I don't want to compete with China. China is too strong for me. So I know I will lose this battle, so I'm not playing this battle. I'm not going to fight today against China and Chinese competitors. So you can make this small exercise for your companies in your portfolio right now. Another practical tip you can use right away. Look at your portfolio right now, look at your stocks, and ask yourself, do I have Chinese competition? And how are my companies doing against the hunger from Chinese guys? Because Chinese companies are very smart, very efficient, very competent, and hungry for more. They are more hungry than most countries, actually. So you don't want to compete against China. Absolutely, you don't want to compete against them. Next point. I use specific thresholds to eliminate 99% of companies upfront. I've talked about the moat and China. I've talked about the real pricing power and Moody's and increasing your prices. I talked about the strong growth, the high margins, the consistent free cash flow per share, and determining the KPIs that are the most important for your stocks. Okay, so I've talked about maybe 6 things in this video. These are the thresholds I use on a daily basis for all my companies, which means these are 6 filters, 5 or 6 filters. And if a company doesn't fit this investment style, I just discard it, dismiss it. And I highly encourage you to do the same exercise, to just dismiss 99% of companies upfront. If you do this, you will not waste any time on bad companies. Your time is precious. My time is precious. We don't want to waste our precious time. The average age of my membership viewers on YouTube is like 40 years old. You probably have children. You have a job. You have family. You don't have time to spend hours and hours on bad companies. Frankly, you don't have the time. Nobody has the time. You want to be efficient. And filters, thresholds help you being more efficient. Okay? So if it doesn't hit my standards, I don't waste time analyzing it. And if you want help building a stock list like this with this high selection and stop guessing, I've helped more than 300 people do it. I have a coaching program. You can book a free call below. This is the first link, the pinned comment below. You can work with me directly so I can help you directly implement the thresholds, the filters for your investing style. Okay, so you can book a free call below. This is the first link in the description. Okay, I see you tomorrow. Bye-bye. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.